So tell me about your position in Hertz. When did you get in? Where is it now?
April of last year, they filed in May, and we bought the debt just before the filing and after the filing, around 35 cents a dollar. And as they emerge from bankruptcy, it's been a very good investment for us because, as you know, it's paying off par. And so it's 3 times our money in, let's say, relatively short period of time. Love the company. It's such an amazing franchise, Hertz. And when you think about the rental car business, it's at the center of this next generation of mobility. And you take out your phone, and you can go to your Uber app, or you can get your just-in-time location delivered for you for a car. And that's what this is going to look like across the rental car industry in years to come. So as you go from combustion engine to EV, as you go from driving to to autonomous vehicles, it's going to be a big, huge sea change that's happening because the rental car companies are the biggest fleet management companies in the world.
So quick follow on that. So it was a good opportunity for a long-term play, or was it also a reopening, things aren't going to go to disaster trade?
When we invested in it, we understood that they're sitting on Hertz in particular, sitting on 500,000 cars. And although they weren't selling it at the point in time, we knew how many people were moving to the suburbs, and there would be a huge demand for cars at a time when the manufacturers started to slow down their production. And so we understood that the residual value is worth so much more than what the markets had priced in. So yes, it was a reopening. Yes, it was an asset valuation play initially. But as we started to study the company more, and Nighthead, run by Tom Wagner, has done a brilliant job in positioning this with Centeris, and we think it's going to do very well in the years to come because it's so well positioned in mobility, and they are just going to be gushing cash flow. You looked at the CPI numbers that just recently came out, 70% car rental prices were up 70% year over year. And we're going to see that persist for an extended period of time through the summer and most likely into next summer.
Bruce, Guy in London, over here the travel situation feels very different. Holidays aren't happening, people aren't moving in the same way that they are over in the United States. Does what has happened with Hertz apply to the rest of the travel sector? Hotels are struggling at the moment because people are unable to travel. The volatility in terms of the government rules still not sorted out. Are we going to see more distress in that sector? Are there opportunities here? Where are you positioned right now?
Well, there's a company that recently, has been in the news, like Hertz, and it's called Europcar. And we own between 10 and 15% of the equity of Europcar, and it's the same play. The company, through their reorganization, has reduced debt from $2 billion to $1 billion, has reduced their fleet by about 30%, and is now generating really strong cash flow. And like Hertz, it's hard to keep cars in the car lot because it's so much in demand. And like Hertz, is in the center of mobility. And Europcar is the #1 car rental company in Europe. And so we're super excited about our equity position in Europcar, just like we're excited about the equity position that we've recently taken as they emerge from bankruptcy in Hertz. Back to Europe, Marathon just purchased 17 hotels in the UK for the reopening opportunity. And this is our operating team we've brought back in, and it's about 4,000 keys throughout the country. And we think we're going to do very well in this. And so you go to Europe, and you go to London, for instance, where you are now, and you can rent one of our Europe cars, and you can stay at one of our hotels. And so, look, July 19th is right around the corner. We just heard from the chairman of Moderna and the founder of Moderna. And we know what these booster shots are going to provide, as well as the vaccines. And we're really excited about the reopening. We're seeing that in the TSA numbers here in the States. So our aircraft that we have on lease to the airlines had a tough spot as well last year, but they've all done very, very well. And now TSA travel, you see the daily take-up is above $2 million per 2 million folks coming through TSA on a daily basis. So travel is restarting. Where you don't see that is with the business traveler. So maybe there's a little bit more issue with some of the B and C office buildings, with some of the long-haul flights and first-class take-up on some of the flights. But drive-to destinations, staying at local hotels, it's magnificent.
What about the stuff that's being transported around the world in terms of freights and things like that? How are you invested there? And like, where is the opportunity? In particular, is like maybe U.S. and China trade is a little bit different than U.S. and Europe right now.
We've avoided freight for a very long time, and we got into it in a very big way in the last year to year and a half, when prices of ships, and these are the big container ships, you know, they're measured in typically 20 TUs, which is a 20-foot equivalence, the size of the container, length of the container, and we have ships that are, you know, 2,000 to 3,000 containers, so kind of like the mid-range ships that are transporting a lot of the goods around the various horns or through the, you know, Suez Canal or through the Panama Canal from U.S. to Europe and Europe to Asia and points along those routes. We were getting, when we started to position the book and buy the container ships, we were getting $8,000 a day for the daily freight rate. Those rates are $24,000 a day on average now.
Whoa!
And the new ones, 26 to 28,000. So we're doing very well. It's great cash flow. We got in at the right time because we're opportunistic in terms of when we position, you know, our investments. And so we got in, you know, kind of at the below the mean line in terms of pricing, probably around 30 cents, you know, relative to its peak prices, and yet we're getting peak prices now. So very well. And trade is big, and there's a big backlog, and whether it's, you know, we think there's 10 million shortages of homes over the next 10 years. And so think about the lumber and the steel and the infrastructure bill that's forthcoming and the reopening of the economy and everyone that needs goods. This is all done through shipping. And so we're very well positioned to capitalize off of the GDP growth away from just reopening, because it also did very well in COVID because everyone was buying all the stuff that they bought for their homes.
Yep. Bruce, I just want to change direction a little bit because we're just getting a bit of news, and I'd be curious to get your take on this, because a lot of the companies you've looked at, and Hertz is certainly one of them, were part of the meme stock phenomenon that completely changed the dynamic. Hertz is certainly one case in point. FINRA, the financial regulator, ordering Robinhood to pay at least $70 million for supervisory failures. Rules cannot be sacrificed, quote, for the sake of innovation. Robinhood failed to report written customer complaints. These are large sanctions. In fact, the largest financial penalty ever ordered by FINRA. Bruce, what did you make of the meme stock phenomenon? What did you make of what people were doing with their money, investing into many of the similar names that you put capital to work in as well? What did you think about that when it was happening? And did it in any way change your beliefs and your kind of way of approaching some of these opportunities?
Well, when you think about the meme stocks and you think about, you know, you mentioned Hertz earlier, and that being one of the stocks, and its share price is trading below 1 at the time, and when it started showing up on the Reddit, you know, and other, you know, chat rooms, we're not part of that. And so at Marathon, we're not in these chat rooms, and we don't jump into, you know, equities because retail's buying it. Listen, retail was sitting home in terms of, you know, the Robin Hooders were sitting home. They had their screens up. They were flooded with a lot of money by the government. The U.S. government sent them this money. And in fact, most of this money has not been spent. By our estimates, it's about 60% of the distributions that were made from the government to consumers are still sitting in bank accounts. And so what do you do with that capital? And so very smartly, they started to invest in equities. And they're very comfortable, I believe, you know, talking to each other and having these chat rooms, and it may not represent value to us, some of the transactions they've done, but for the most part, you know, I think it's a free market, and it's up to the federal regulators to make that decision as opposed to free marketeers like us to opine on that. So I don't know how you regulate that. I think it's a very difficult decision from the SEC and from FINRA. But the consumer is flush in cash and likes the stock market for good reasons, because there's growth in his earnings.
But on the same on the same bent there, there are different banks like Goldman Sachs, et cetera, that are trying to find ways to make money off of this, like tracking the trends and the short interest, and then having an index that tracks short interest in stocks and whatever. Is this a big enough deal for you to monitor in any significant way to affect deals that you could make? Does it make things less distressed when it needs to be more distressed?
Well, you know, we talked, we opened up today, we talked about distress ratios and defaulted credit. You know, we believe that default rates will be 1%, which is kind of all-time record lows or harboring around those record lows through the end of next year, because there's so much capital in the system. And like Marathon, there's many professional investors that are making loans to companies to help them through the rough spots. And we call that capital solutions. And so we're working with a lot of troubled companies here in the US, in Europe, providing these capital solutions. And so we're more focused on capital solutions for, you know, good companies. And some of those companies are some of the stocks that you might refer to as these meme stocks. But we're, from a credit perspective, helping these companies getting through the rough spot so they don't have to file for bankruptcy. And so they can have working capital to thrive. You know, there's a company, AMI Entertainment, which makes jukeboxes. They have 40,000 jukeboxes. They make them, they install them, and they manage these jukeboxes.
Love this.
And so we financed this company. And when they had a little tough spot because their revenues were down 90% during COVID, because the bars and restaurants and pubs that house these jukeboxes were closed or open with very few patrons. And now these bars and restaurants maybe are only 1 or 2 people deep, not 5 people deep, so they're only 50% occupied. Revenues are record level of revenues within a quarter of us putting our capital in. Now that they've been able to reopen restaurants and pubs and bars, and people can do what they want to do. Play music. Who's Bill Ackman, you know, just bought, you know, a stake in Universal in his de-SPAC process. And when he did that, what did he say? He said people love their music. And I can attest to that because I see the numbers of AMI, and it's a great company that, you know, serves that purpose.
Bruce, just to come back to Alex's point, and one final quick question from me. AMC, the movie theater chain, effectively did a debt for equity swap via the whole meme stock phenomenon. Were you surprised that they were able to do that in the way that they were able to do that? They were quick, they were nimble, they took advantage of the situation. They completely changed their capital situation almost overnight.
It's absolutely remarkable.
If retail investors are able to do this more often, how does that change the dynamic for you?
Well, I think, God bless, first of all, they're using their capital to help a company that's troubled, and it was a great opportunity for AMC. We didn't take a position in AMC because we weren't quite sure of the theaters. We were much more sure that trade would, you know, remain strong, that, you know, hotels would reopen, that, you know, people would get back on planes and begin to fly, although the business traveler, you know, would be, you know, delayed in that response. And so we positioned ourselves what we thought were the sure bets or the much better investments. And we weren't sure about AMC. It's a great company, but we just weren't sure about it. We didn't have that vision. And that's okay, because there's lots of different opportunities out there, and there's lots of investments to make. It just wasn't one of ours. But the meme stock capital that came into AMC and how they capitalize off of that really helped that company. So I don't begrudge that at all. I say, you know, I applaud them because we all want to see theaters survive. It's good for America. It's good for, you know, it's good for us to get back to being able to go back and have an evening of entertainment. So I'm all for it. And I think that's a good use of capital and turned out very well for AMC.